All right. Hello, everyone, and welcome to another episode of Gimme Some Truth International Edition. Dis-moi la verdade. Dis-moi la vérité. Right. I'm joined today by my two colleagues. I try my best, okay?
I like it. Like it.
I'm joined
Still doesn't want us to catch on that he's not from France at all. He's actually from Tuscaloosa, Alabama. It's his great secret.
I thought it was Paris, Texas, right?
Yeah.
I'm joined by my two colleagues, Stan Farmer and Keith Poniwaz. And the topic for today is Roth IRAs, right? So we're going to talk a little bit about Roth IRAs and things you need to be aware of when it comes to using a Roth IRA as an expat, right? So, we like Roth IRAs. I think by and large within the firm, we...
On differing scales. I mean, our colleague Alicia on the domestic side, I think we like them. She may love them.
She loves them.
I think.
I
think maybe the 529 is number one, and then maybe the Roth and her.
Yeah, not far behind.
There's a scale of Alicia's worship, and I think that yes, it holds a very high place on the totem of love.
I think Clint recorded a podcast called Rothify Your Life. So I think it's fair to say that we're big on Roths.
Yeah,
but we would call it Rothify with caution.
Right, exactly.
In expat world.
Exactly.
I'm beginning to notice a pattern for all of our podcasts. It's with caution.
Right.
Or
it's all about caution.
We are the breath of cold water on thrown on your investment design.
Pretty much.
For your own good.
Pretty much. And so as exciting as Roth IRAs are for, U.S. residents, there's some complexity once you throw in an international cross-border situation. And today that's what we're going to talk about a little bit. So just to go over the really basic stuff here, the reason you would put money in a Roth is because, you contribute with after-tax money. And then the benefit is in retirement, you could take a tax-exempt withdrawal. So that's a great arrangement for a number of reasons.
Yeah, well, and even if you're a younger person, it's a great, if you're just domestic, if you're just in the U.S., it makes a lot of sense for a whole bunch of reasons. Mm-hmm. You put in money you paid taxes on, pull it out tax-free. You can pull out after 5 years any of the contributions that you've made, tax-free.
Mm-hmm.
So for funding a house or something like that, an IRA, you can only pull out $10,000 for your first house purchase. A Roth, if you contributed more than that, you can pull that all out if it's been in there for 5 years and not pay any tax. So a Roth is really a great savings vehicle if you're younger and you're doing a great job of saving. So
fundamentally, if you had a menu of options for me and you said taxable, tax deferred, or tax free, I'd say tax free, please. Right? I mean, It's that basic. And then obviously there are those additional features if you want to go into the cookie jar earlier in life. But you can do that too.
If you're a young person, make sure you're making good money, but not huge amounts. Make sure you're filling up that Roth bucket, I think is what we're trying to say.
Big time.
Absolutely. And so we like Roths. Obviously, we often compare a Roth IRA to a traditional IRA, right? Traditional IRAs kind of, it works the other way around. So you contribute money into the traditional IRA, you get a tax deduction when you make the contribution. But when you pull money out of it in retirement, you're taxed on it, right? And so if you take $100 out of the account, that's $100 that's added to your taxable income for that year.
Yeah, and I think that's important because a lot of people don't understand. It's the whole amount you pull out is taxed at your income tax rate, not at your capital gains tax rate.
Yeah.
And so that's something that a lot of times people don't understand.
Yeah, absolutely.
And I think is also important as we talk about it in terms of moving abroad and so on and so forth.
Yeah, absolutely. And so where does the added complexity come from when we talk about using or having a Roth IRA as an expat?
Right. As opposed to
a normal IRA.
A traditional IRA.
A traditional IRA. Because I will say this about traditional IRAs is that they are generally, I would say, better understood by non-US, foreign tax authorities, right? Because they're very easy to relate to similar types of retirement accounts, tax-deferred accounts that are available under local law.
Right.
And
in the world of countries that are developed and have income taxes to begin with, right?
Right.
Most of them have some kind of retirement device that at least, somewhat resembles an IRA.
And in the case of countries that have income tax treaties with the United States,
yes,
I think it's fair to say that it's very easy to make the case that a traditional IRA would meet the definition of a pension under the terms of the treaty, right?
Which is critical.
And most of the time, if you read, there are two parts to a treaty. There's the treaty itself and there's the technical explanation. Under the treaty, under the technical explanation, they'll very frequently point out, pension includes 401k, IRA, etc. So it's clearly laid out there.
That it was the intent at the time the treaty was created for that to encompass the IRA, yes.
And so the net result of that is that for the most part, and again, there are exceptions to this, but for the most part, if you have a traditional pre-tax IRA or a rollover IRA, in the same way that if you had a 401k, you can be reasonably confident that your country of residence, even if you live abroad, would treat that account as tax deferred.
Tax deferred.
And the tax event only happens when you withdraw the funds, and it's very simple at that point because everything you withdraw is taxable, right?
Yeah, no, I think the other thing there too, I like to refer to, kind of a force field around these kind of accounts, as well for accounts coming back to the U.S. or for tax purposes because they're covered by the treaty. They're not going to look inside of that. So if you're worried, I have investments that aren't compliant with no local law,
right.
I have, this or that, you don't have to worry about that at all because they're just looking at that whole round amount of that outside of it.
Because they're not taxing the underlying investment, they're taxing the withdrawal of money.
Exactly. So they don't care what's inside of that. So you have to worry less about local regulations on investment accounts and so on.
Right. Now, it might get a little bit more complicated when it comes to the Roth, right? Because I think it might. It won't always be more complicated, but there are cases where it might add a little bit of complexity because at the end of the day, this provision in the tax code that allows you to take tax-exempt distributions from a Roth in retirement after age 59 and a half is purely a U.S. tax provision, right? And you can't just assume that it's going to apply in the exact same way in your country of residence. Right. And that's really the key issue that expats have to grapple with, is that if you have a Roth, you effectively need to take a position as to how your local country would treat those withdrawals in retirement.
Yeah. Well, and I would also say, there are cases, and this is important, where certain countries don't even treat the Roth like a retirement account. They just treat it like a straight-up brokerage account.
Yeah. And for reasons that may very well be what you were discussing before. You don't have to be a certain age to take money out of it if, you've had the Roth for 5 years. You can take your principal back out and so on. The U.S. takes similar positions, for example, with a UK ISA. Right, it is Roth-like. It's a tax-free savings account, but because you don't have to be a certain age before you can take money from it, it's not a retirement account. Therefore, it doesn't meet the definition of pension. And there are certain foreign tax authorities that may come down to the conclusion that it's not a pension at all.
Absolutely. So two really important issues there. So number one, is my Roth IRA even treated like a pension? So is it actually a tax-deferred account in my country of residence? And if it is, the other option, the other question is, how will my country of residence tax the withdrawals that I'm making from that account in retirement?
Yes.
So two very kind of tricky questions to answer. And they're tricky because they're very country specific, right? So I don't know on this podcast if we can't, give you one answer as to exactly how your Roth is going to be treated abroad, because it's going to be.
If you're moving to Germany, it's going to be different than if you're moving to Netherlands.
Exactly.
If you're moving to France.
Exactly. So every country is going to be a little different. I will say that there are some income tax treaties that the U.S. has with different countries around the world that actually clarify specifically how a Roth would be treated. But it's a few countries.
They're few and far between.
Exactly. Yeah. So some of the better treaties that we have, treaties with countries like Canada and the UK may have, language that relates to the Roth. But, again,
Canada's an interesting case, because there's language that relates to the Roth. But if you move to Canada, you need to make sure that you declare your Roth. Right?
Exactly. So even like
in the simple cases,
there could be just little intricacies that you need to be aware of. So you need to be very careful and look at every situation on a case by case basis, right? The beauty of the Roth is that it's a very flexible type of account. And so, some of the work that we do with our clients, for example, if you're in a country temporarily, so where, maybe you're moving back to the US, you could be in a situation where you don't have to deal with the complexities of having to take a position as to how the withdrawal should be treated, because the Roth doesn't have some of the required minimum distributions and things like that would apply to a traditional IRA. So the Roth is an account that, you can keep and not take any withdrawals from.
Yeah.
So sometimes that in itself is enough to...
I think that's really important as well for a lot of folks. Maybe your kids are still in the U.S., you're living abroad, retired abroad, and you don't need all of that money that you're going to pull from your RMDs. It's going to put you in a super high tax bracket in your local country. So before you move abroad, maybe a good idea to convert some, or even if you're in a case where you're in a country where you can convert fairly easily, the tax burden isn't terrible, to convert so that you're not hitting up against that high amount.
Yeah, and that's so important.
And then you're doing sort of estate planning. So it's,
and I think that's a great
case is country and individuals.
That's a really great point, because I think we don't want to sound like, okay, you should not use a Roth if you're an expat, because there may actually be situations where a Roth is perfect, right? There may even be
countries where it works.
Yeah, exactly.
Also, expats are, their long-term plans are always in flux, right?
Right.
You may be working in London now. You may end up, deciding that you want to retire to Spain. Those two countries treat Roths very differently, right? But you may ultimately decide that you want to retire back in, God forbid, Florida, right? I mean, so, ultimately there's, it's always a bit of a math problem, with whether or not the Roth conversion makes sense domestically. Internationally, there's this probability of, this is what you're intending to do. Are you coming back to the United States? Are you, do you know ultimately where you're going to live? Or are you going to go retire in one country where it works, but then decide that you really prefer to live somewhere else where it doesn't, right? By far one of the worst things, that I've, talking to new clients or potential clients on the phone, one of the worst, bit of news that I have to deliver, and it's happened on numerous occasions, is, I retired last year, planning to move, to country X, right? And, I have converted all of my IRA assets, all of my 401k into Roth. And then to tell them, that was a huge mistake is a horrible thing to have to say.
Yeah, but by the same token, you could be moving to a Roth-friendly country that also has very high tax rates. And that would be a situation where you may actually have an incentive to convert everything you own in pre-tax money into a Roth.
Exactly.
Right?
Well, and it's a case where,
it really depends.
Maybe Stan has to play travel agent and say, "Oh, you thought about retiring."
Well, wait, I've got a solution for you.
Yeah.
Move somewhere else.
Yeah.
Exactly.
I know all of your family is from Spain, but have you considered the south of France?
You'll live longer if you're not kicking yourself every day because you made a conversion and paid taxes out the wazoo, and now it's a bad thing.
And, and now you're going to be taxed.
You don't get to enjoy the fruits of that pain.
Yeah.
Right.
Yeah.
Right. Absolutely. And again, every situation is going to be different. But the problem is that, again, you could be in a situation where you're thinking that you're taking a tax-exempt withdrawal only to be told that it's actually taxable under local rules. And then the question becomes, okay, is all of it taxable because they just blindly assume that it's all coming from a pension?
From pre-tax dollars.
Right, from pre-tax dollars.
But it's not.
Can you take a position that only the growth is taxable because the contributions were after tax? And then you get into questions about, how do you document the basis? What records did you keep, et cetera, et cetera. So things get very, very complicated.
Right.
So again, lots to think about when it comes to Roth accounts, and really they could be your best friend as an expat, or they could be your worst enemy. So it really depends. Just be very careful, review your situation based on your country of residence.
By the way, he delivered that fear pitch in just the most perfect calm tone. Like this could be the end of the world as we know it.
Yes.
All right. So look, nothing to worry about. If you're getting the right advice, things will go well.
Yes.
But start planning ahead, I guess, is the key message here. Because, if you made some, decisions that weren't optimal, it may not be too late. There may still be things you could do to limit the damage. And certainly by working with the right people ahead of time, ideally prior to moving abroad, you can ensure that you don't, have any sort of bad surprises. So hopefully this was a good introduction to the topic, and we'll wrap it up for today, and we'll see you next time for another episode of Give Me Some Truth International.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.